This segment sponsored by Foster Financial. It is time for another edition of Money Monday with Foster Financial. And joining me today is their Vice President, Caleb Doane. Good morning, Caleb.
Good morning.
How's it going?
It's going well. How are you?
Good. Okay, so today we're going to talk about corrections with the market. So what does that mean exactly?
Yeah, so a market correction is a 10% drop from a recent high, and we're not in one right now, so nobody has to kind of worriedly, pull out their phone and check their balances. But I think a lot of times we talk about these when we are in a market correction, and historically that's when investors act the most irrationally, right? When the market is down, and so it can be prudent to talk about some of the strategies when we're not in a market correction, just to kind of know what opportunities might pop up there. So a lot of times when we see that the market drops, that can be a good opportunity to do certain financial planning practices, whether it's Roth conversions or reallocating the account, maybe even investing some money that somebody has in cash. So there are good opportunities that pop up when we do see the market dip.
Okay, so that's funny that you say the market dip, because we sit on parallel sides at moments, because don't we want the market to rise, like in some aspects of our finances, but then we want it to dip in other aspects. So can you explain those two?
Yeah, I would say, far and away, we typically want the market to rise, right? But when it does fall, it can kind of add some little benefit in that it can create opportunities for certain tax strategies. It can create a good opportunity to buy into the stock market if we're anticipating a recovery. So, I mean, theoretically, if I could control the stock market and I could make it, drop 50% tomorrow and then go up, 100% the next day, obviously, that'd be a great opportunity to buy when the market is down. Now, of course, we don't know what the market is going to do. So there's never a recovery that's promised in the market. But we can kind of look ahead and try to anticipate what we expect the market to do. Sometimes those drops can create good opportunities, like Roth conversions or something that we typically do when the market drops. When you do a Roth conversion, you're paying the taxes on the money that you're moving from an IRA over to a Roth IRA, and you pay it on the balance that you're moving over. So if the market drops and that account value goes down, you're paying a discounted price in the taxes when you do that conversion. So there's different opportunities that come up when we see these market corrections. So we don't always have to be terrified of a market correction. It is a normal process in the stock market.
Okay, and so the correction isn't when it drops and then it comes back up and corrects itself. So you're saying the term correction literally refers to the drop itself. To the drop itself,
basically saying, hey, the stock market was a little bit overvalued before, so now it's correcting back to its kind of fair value there. So that's typically what we call it. And then the recovery is when we get back to all-time highs. So we're close to all-time highs right now in the S&P 500. But it can be wise to kind of enjoy it while we're here, and it could continue going for the rest of the year. But seeing those market corrections are not uncommon. We saw one in March when the stock market dropped a little bit there. So it's not uncommon to see those every year or every couple of years. And that fluctuation and volatility is something to expect, and we just invest our clients' accounts at a certain risk level that's appropriate for their goals and their risk preference or risk tolerance when it comes to investing.
Okay, so what would be the long-term goal or short-term goal? Like, what is the quickest way to make money in this type of correction situation?
Yeah, so I mean, typically we're investing for the long term, right? So I mean, we're investing, pursuing a certain kind of risk preference or risk tolerance in the account for the long term, and then we just understand that there will be some of those short-term market corrections, short-term volatility in the market, and then we just have to make sure that fits within the client's plan. So if they're taking withdrawals, there's a certain amount of conservative assets that we typically want to keep in the account that we can pull from even when the market drops. And then we just might know that, hey, this client is a really good case for Roth conversions or diversifying away from a legacy position that they have. So when the market drops, we actually have certain tags in our system that we can look up and say, hey, the market's dropped, let's execute this planning strategy for this client.
Okay. Now, can you explain what a non-qualified or a non-variable qualified annuity is?
So a non-qualified annuity is an annuity that you funded with after-tax dollars. So typically people are taking it from their checking or savings account and they're contributing to an annuity with that money. They have to pay taxes on all of the growth. And so sometimes we'll see that's another opportunity that can come up when the market drops, is that account value has gone down a little bit. And so similar to a Roth conversion, to sell out of that position has now costed you less in taxes. And then we can reposition it into a different type of account that might serve their needs better.
Okay, gotcha. And so during this time, is this a good time during the market correction to diversify your investments by maybe pooling and redistributing?
Yeah, exactly. Yeah, sometimes we'll use those market corrections as opportunities to both do Roth conversions and maybe diversify away from or sell out of some of those non-qualified variable annuities that clients have.
And then last question for you, Caleb, how would someone know that we are currently in a market correction?
Yeah, I mean, sometimes you'll see it on the news, right, saying, hey, the S&P is down 10% from a recent high. And a lot of times people will notice it just in their investment accounts. They'll look at their 401k at work and they'll see, hey, this is down a little bit from when I had checked last quarter. And so it just depends how in tune people are with their balances that they have in their investment accounts. There's a lot of times if people are just, more so passive investors and don't really keep up with the market too much, they might not know that the market is in correction territory. But that's where it can be beneficial to have a financial advisor, keeping a pulse on everything and seeing if those opportunities present themselves.
Yes, wonderful. Thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their phone number listed below so that you can give them a call for a complimentary consultation, and they can help you through all this market correction and more. And I'll see you after the break. This segment sponsored by Foster Financial.